global economy's had a really strong recovery, but we're now moving into a much more difficult phase. Inflation has picked up significantly, central banks are hiking, and growth is starting to slow down. So unfortunately, I think it's going to be quite a challenging year. The US has had a really strong recovery, and frankly, the economy is now overheating. They have a problem. They have very low unemployment. It's 3.6%. Employment is still growing at nearly 400,000 a month. And inflation is the highest it's been since the early 1980s. So the Federal Reserve is moving very quickly. I think that will continue, and their intention is to move to quite restrictive policy over the second half of the year. That is likely to slow the economy down. And whilst it's not certain, and the Federal Reserve are still aiming for a soft landing, I actually think it's going to be pretty difficult to pull off. So I think there is a high likelihood that the US has a recession next year. China's in a very different situation than the rest of the world in that they still have a zero COVID policy. So they actually had a big economic contraction in Q2 this year because they locked down, because they had a COVID outbreak. It looks like COVID has come back under control, but because Omicron is so contagious, I suspect that they'll have further outbreaks, and it'll be like the rest of the world was over the last couple of years, where it'll be sort of start-stop kind of economic activity. Europe's in a really difficult position at the moment, in large part because they've had such an increase in energy prices, and in particular because natural gas prices have increased, electricity prices have increased a lot. So both in the UK and Europe, they have very high inflation rates at the moment. That means that real wages are falling, and even before the ECB has started hiking, it looks like Europe is tipping into close to recession. So really the ECB is sitting on the horns of dilemma once again. They are likely to hike over the next couple of months because inflation's so high, but it's very unusual for a central bank to hike very much in a world where economic activity is already contracting. Australia has had a really strong recovery, and remarkably, we've now got unemployment the lowest it's been since the early 1970s, and it's still coming down quite fast. The RBA was patient. They waited until we got to full employment, but now they're moving very quickly. So at the moment, growth is very strong, activity is growing very rapidly, but the RBA will now deliberately need to slow that down. And my guess is as we move into next year, growth will slow materially. I think Australia might be able to avoid a recession because our wage growth is not as strong as elsewhere, but I think it'll be touch and go. Commodities are really interesting at the moment in that over the past year, a lot of people have been talking about commodity super cycle. They've been talking about the impact of the war in Ukraine, and they've also been talking about the energy transition as a catalyst for strong demand for a lot of metals in particular. The problem with that analysis is that commodities always move very closely with the global cycle, and as global growth has started to slow, commodity prices have come under pressure, and in particular things like copper have come down very heavily already. As we move into the next 6 months, I think that broad trend will continue, but of course there are some pockets where things will be different. European natural gas is still being driven very much by fears of Russia holding back gas to Europe. So I think those prices will stay elevated. Whereas on the other side, I think that some of the industrial metals will come down further. The war in Ukraine's been very interesting in that obviously it's a humanitarian tragedy, but more broadly, if you look at most market prices, they've actually returned to where they were before the war. So again, the problem with these things is often these regional geopolitical events very difficult for the region, but their broader economic and market impact is actually pretty modest outside of in this case, commodities that are directly affected. And in particular, I'm thinking about European natural gas. It's really interesting in that in the near term, what we've seen is particularly with energy shortages and people very concerned about getting the next bit of gas out of Russia, we've seen Europe in particular turn back on fossil fuels. And in particular, Germany has started to build LNG import terminals and have actually turned on some coal production. So when faced with energy shortages, it is really clear that the world will need to actually use fossil fuels more. So the main lesson I take from that is that the world needs to build the alternative capacity before we can turn off the fossil fuels. Having said all of that, what this has shown is that it's a bad idea to be very reliant on other countries for your energy. And if you're Europe and you don't have energy reserves, you will need to move more quickly to a renewable future. So in the near term, it's a setback, but I think in the medium term, it will actually accelerate the transition. Equities are really interesting in that normally year to year, equities move very closely with economic growth. And what tends to happen is you have a recession, and then you have a long recovery, and over the recovery, equities re-rate higher. So the PE moves higher. Then you have a recession and they reset again. That's exactly what we saw in the last decade. But the problem we have now is that equities at the beginning of this year were very expensive. If you look at the Cape PE, they were the most expensive they've been in history, except for March 2000. They were actually more expensive than October 1929. And of course, now interest rates are going up rapidly. So we've seen a really big fall on equities this year. It won't be a straight line. There will be bear market rallies, but my fear is that it's probably got some way to go. The US dollar, again, is interesting in that the US dollar at the moment is benefiting from a rapid Federal Reserve, but it's also benefiting from risk off. And what tends to happen is that when people get nervous about the world, people move into safety, and of course that's the US dollar. So for both of those reasons, I suspect that the US dollar probably has further to move. Having said that, it is now very expensive. In fact, the US dollar in real effective terms is now the most expensive it's been since the mid-1980s. And on that episode, it was so expensive that the G5 central banks intervened and brought it down again. So I think it will move higher, but you're starting to move into stretched territory, and at some point it will come back down again. The Australian dollar is almost the inverse of the US dollar, in that one of the strengths of the Australian economy historically has been that when the world gets rocky, the Australian dollar falls and acts as a shock absorber. And that's exactly what's happening now. In the world I'm describing, where in all likelihood we have a US recession next year, my suspicion is that the Aussie dollar will fall further, and it's quite possible that we fall as far as 60 cents to the US dollar. In summary, it's been a really rapid recovery. Unfortunately, central banks have been a bit too slow to act. They're now playing catch up. That is going to make it quite rocky. My suspicion is that we probably need a mild recession next year to bring inflation back down and reset the economy so that we can start another expansion.